It's time for Yahoo Finance's Market Minute. Stocks rallying, stalling as Wall Street seeks clarity on President Trump's tariff plans. Nvidia under pressure today amid fears of stricter regulation of its chips in China. The Financial Times reporting Chinese regulators are discouraging big tech companies from buying Nvidia's H20 chip. This comes as the U.S. adds dozens of Chinese companies to a trade blacklist over national security concerns. GameStop shares popping as the company goes all in on crypto. The video game sellers board unanimously approving an investment policy to add Bitcoin as a reserve asset. And Dollar Tree is offloading its struggling Family Dollar business to private equity for $1 billion, well below the $9 billion the company paid back in 2015. Sale expected to be complete in the second quarter of 2025. Dollar Tree forecasting a 30 to 35 cent full-year earnings hit from the cost of the sale. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code below.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. We check into the traditional 60-40 stock-bond allocation to discuss whether it still holds up today. And the Department of Education is reopening the online portal to apply for income-driven repayment plans. We discuss what students can expect. Plus, all this week, Wealth will discuss spring cleaning your finances. We'll dig into different areas of your financial life, your budget, investments, and debt strategies in order to get you on a good financial path for the rest of the year. Oh yeah, we're stepping on some toes out there, but get ready. We're just trying to help everyone. First up, we got to take a look at the market action here on the day. 90 minutes into the trading day, stocks are mixed, following a 3-day winning streak. Joining me now, we've got Jim Caron, who is the Morgan Stanley CIO of Cross Asset Solutions. Good to have you here with us. Amid this recent volatility, you say investors may want to rethink that 60-40 portfolio strategy. Why is that, and how should those percentages shift?
Yeah, thank you for having me on your show. Look, I mean, I think the 60-40 portfolio can be misunderstood in some ways as being this magic ratio that's out there. Effectively, the way that the 60-40 portfolio worked the best was really from 1981 to 2021, which was mainly driven by the fact that interest rates declined during that period. 37 out of 40 years, bonds had positive returns in that 1981 to 2021 period. That is what drove the stable performance of the 60-40 portfolio. And it gave you a return between fixed income and equities somewhere around 7.5%, and which was a very good risk-adjusted return. Now, if we imagine a scenario like today where interest rates do not decline, which means that bonds do not have steady returns, interest rates just move sideways and in a channel, which means that bond returns may fluctuate. If that starts to happen, then essentially that stable return profile in the 60-40 will actually start to come down, and bonds will start to correlate more with equities. And the average return from many of the capital market assumptions that we have might be more like 5% returns in a 60-40 as opposed to what we saw with 7%. And that 5% is going to come to you, 5% return is going to come to you with higher volatility.
Okay, so let's break down, because we just threw a lot of numbers at folks, but let's break down perhaps bucket by bucket where the best opportunities are within each of those percentage allocations. And so if we were starting with, what the equities bucket should look like, what are you identifying there as a clear strategy?
So I think there is two components of this. One is how you manage your money, right? So when we typically think about 60-40, we think about passive investing, like buying an ETF in the S&P 500 and an ETF in some bond fund. That passive strategy won't work as well. The style change is what needs to happen here. You need to start thinking about investing in more active asset managers or active ETFs. So that way the bond component of your portfolio will manage the duration a bit better. So the way that we typically start to think about bonds is I'd have slightly less duration in my portfolio. So in other words, I'd have a mix of high yield, I'd have a mix of bank loans, municipal bonds, for high quality and also U.S. Treasuries and investment grade, but I'd keep some of the longer duration in the credit space and the higher quality short duration in like U.S. Treasury. So it's more of a barbell type strategy where you can manage the duration of your fixed income component of the portfolio. On the equity side, we have to now really start to think about diversification. So it was really about Mag 7, large cap tech over the past 10 years or so. Now it's going to be much more idiosyncratic. So we have to start thinking about large cap value. I think mid cap sectors can do well, mid cap value, even a little bit of small cap. So the sectors that we tend to start to like, more trend like, are areas like materials, industrials, even healthcare. Healthcare can be a little bit defensive, but it can also have some pretty good gains, going forward as far as we see it. Even on the financial side, if we think about deregulation in markets, I think financials can do reasonably well. But again, it's really about the style of how you're creating your portfolio, going from a passive type of a strategy to something that's a bit more active.
I'm going to ask you something, Jim. How far away do you think we are from another number within that mix? We've talked about 60-40, we've talked about 70-30, but there are some firms that are talking now about adding on some cryptocurrency exposure, and I knew you probably knew I was going that direction.
Yeah, I love that question because you're exactly right. 64. We should not be confined to two numbers, right? Maybe we should think about alternatives, and that could be crypto, right? That could be also private equity, it could be private credit, it could be infrastructure, it could be real estate. So we can't think of it as just 60-40 equity and fixed income. The new ratio might be something like 60-20-20 or 60-30-10. Nobody really knows what that golden new number is, but I think what most people are really deciding right now is that it's probably not 60-40 passive. So we're trying to look for that other piece to make up for the for the potential lost return in the passive 60-40 portfolio and give you the diversification and stabilization into your return profile. That's really the key. You want to stabilize your returns, and you need diversification to do that. So you may need to add a third asset class, whether that's crypto or it's alternative investments. That's up to whatever the comfort level of the investor is.
Jim, thanks so much for taking the time here with us today. Really appreciate it.
My pleasure.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Wingstop initiated at Wells Fargo with an overweight rating. The analyst says the stock could bounce back later this year. Due to multi-year sales drivers and strong free cash flow, the firm does acknowledge near-term hurdles like a difficult backdrop and weak comp sales in the first half of the year. But the analysts also set the price target to $270 a share. That's implying 23% increase from the stock's last close. Next up, we're tracking shares of CarMax, getting an upgrade from Stephens ahead of its earnings report to overweight from equal weight. Now, the analyst is optimistic about the real-time unit sales and credit metrics, particularly in the first half of the year. So the firm also noting here that the used car retailer will likely marginally benefit from most tariff scenarios, at least in the first year. Finally, a couple of calls on the healthcare companies. Morgan Stanley initiated coverage of Tenet Healthcare with an overweight rating. The analyst saying Tenet's business improvements aren't yet reflected in the stock. And while government spending cuts present a short-term risk, long-term investors may find a good opportunity. The firm also initiating Tenet's Pure Universal Health Services. That stock given an equal weight rating, and the analyst says that the risk reward is balanced with overhang from uncertainty around potential government spending cuts. Dollar Tree announced today that it was selling Family Dollar, capping a decade of woes for the discount brand. The dollar store industry has faced steep headwinds in recent years as low-income consumers have struggled to afford even basic necessities. Now, other retailers are noting a more broad consumer slowdown across income levels thanks to pressure from inflation and tariff uncertainty. Joining us now with a look at the U.S. consumer, we've got Mark Matthews, National Retail Federation Executive Director of Research. Good to have you here with us. First and foremost, I just want to get your reaction to the significance, perhaps, of what this is spelling out more largely about the state of the consumer.
Yeah, absolutely. Thank you so much for having me here. If we look at the consumer, we put out our retail sales monitor every month. The last 2 months, we've seen some weakness. We've seen down figures month over month. And if we look at January consumer spending data, we saw a real 0.5% drop in spending. Now, it's important to note that disposable income was strong, but what we're seeing consumers do is choose to save rather than spend, given the uncertainty in the economy. It's also worth mentioning that the census also releases retail sales data. They showed retail sales down on a year-over-year basis for the first time in 57 months. So we had a long streak of year-over-year gains that was broken in February.
And so, with that in mind, as you're thinking about where the consumer makeup is continuing to remain strong versus the faster deterioration that we might be seeing, what are you tracking across those different income levels, and what we would need to see consumers have some confidence in order to see a bounce back at some point?
Yeah, so we're seeing some real softness in lower income households, which is to be expected. The way I think about the consumer, I'm referring to them as the bodybuilder consumer, right? Juiced by pandemic stimulus, they've been doing all the heavy lifting in our economy for the last few years, but there's not a lot of body fat on them right now, especially for low to middle income households. The Fed does a survey asking households about their ability to come up with $2,000 to deal with an unexpected expense. Their most recent data showed the lowest level of consumers' abilities to fund an unexpected expense since the survey started in 2015. So I think that there's some real concern about the ability of consumers to navigate their way through an economic downturn.
And so, as we're thinking about where consumers are needing to spend versus where they want to spend, it seems like looking across the makeup of goods versus services, and of course we're going to get PCE this week and get even more of an update and a read in there. If services continue to remain elevated, and for much of the needs categories of those services, what does that translate through to some of the goods manufacturers from what you're also seeing in the data?
Yeah, it's a great point, great question. I think the challenge for retail is that we have no inflation in retail. It's deflationary in many categories. Most of the inflation that we're seeing in the economy is skewed towards the services side, which creates a challenge for retailers, right? Retailers, you need to sell more just to show a gain over the year. But I think if we look at the consumer and what the consumer is doing, your comment about needs and wants is exactly right. We are seeing consumers shift away from discretionary spending towards essential spending, and within the essential category, we're seeing them trade down to lower cost items. So a lot of the behavior that we saw during the pandemic, when we had high levels of inflation, we're beginning to see that happen again.
And so the net tariff impact that you're going to be monitoring for, what is that?
That is very, very challenging to measure, right? Because we just don't know the depth, the quantum, the length. It's very difficult to understand. I think the biggest issue right now is the uncertainty that it's creating. Uncertainty amongst the consumer. So the consumer is thinking, maybe I don't want to spend, maybe I'd rather save. But even more worrisome, we're seeing business investment dropping. There's a recent survey of CFOs, and they expressed a lot of concern about the economy. The thing that's keeping this consumer going is that we've had 2 years of real wage growth. The moment that you start to challenge, a really strong, unemployment level, decent increases in job growth, the minute businesses start looking at reducing salaries or reducing employment, that's when things get a little bit worrisome.
Mark, a tip perhaps for consumers here. How can consumers be smart and be diligent in their shopping even recognizing where tariffs would impact some businesses versus won't, and how some of the businesses are going to act as if they're impacted but still try to push through price when perhaps it's not as outsized an impact, or they've taken previous measures and already inputted that into their own kind of supply chain management and logistics system in order to make sure that their business has been insulated.
Yeah, it's going to be a challenge to navigate for consumers because there are so many potential tariffs out there that are going to affect so many different products in different ways. And I've seen a lot of retailers put out estimates of how much they see prices increasing. In the past, we always tell consumers to shop around. We have easier price discovery than we have ever had in the past. And I think it is really going to be on the incumbent on the consumer to make sure that they use all those tools to allow them to shop around and also to look across categories, right? To look at substitutions, different ways that they can keep their grocery bill and other bills down so that they can manage to afford the challenges that we're seeing coming forward.
Mark, great to see you. Thanks so much for taking the time.
Absolutely, my pleasure.
Coming up, more federal workers are applying to jobs, why DOGE is likely behind some of that surge. That's next on Wealth. According to Pew Research, the U.S. has nearly 40 million student loan borrowers, and many have been wondering about the future of their loans after President Trump declared his intention to shutter the Department of Education. A new survey from the New York Fed suggests 9 million of those borrowers could see their credit scores decline as a result of delinquent loans. Yahoo Finance's own Jordan Weissman has the details. Hey, Jordan.
Hey, so thanks for having me.
Absolutely. So let's dive into this. What is the potential net impact that we could see here, and now the move that we're seeing from the Trump administration?
Right. So about the 9 million potential delinquent borrowers. For the last year, student borrowers have been repaying their loans after the pandemic pause was lifted. However, if people were late on their payments, that was not being reported to credit bureaus, right? There was sort of this on-ramping period where you could miss a payment, but it wouldn't affect your FICO score. That's ending. For the last several weeks, student loan servicers have been reporting late payments to credit bureaus. So finally, if you are not up to date on your loans, it's going to impact your ability to borrow. And the New York Fed thinks they did some number crunching. These aren't the official data, but kind of the preliminary numbers suggest there are 9 million people who could be affected by this, who are already behind. That's actually a higher percentage of borrowers than before the pandemic. So people are having a harder time paying back their loans now than they were, say, in 2019. As far as the effect of the closure of the or potential closure of the Department of Education, I should say, there's just a lot of confusion right now around the student loan program. People aren't sure what's going on. They only just today are supposed to be restarting applications for some of the income-based repayment programs that have been paused. So, confusion doesn't help. If people are having trouble paying back their loans, everything being in a little bit of chaos is probably going to make that worse.
And so another update for student loans, the Department of Education planning to bring back income-driven repayment plans. What are you hearing on that front?
Right. So since February, essentially, the Department of Education has been blocking off access to income-driven repayment plans, which cap how much you owe each month as a percentage of your income. They did that in response to a court decision, but people have sort of been wondering, okay, when are you going to bring them back? When are you going to fix the applications and let people apply for the stuff that's not affected by the litigation? It looks like they are going to, some lawyers of the government in a lawsuit yesterday suggested that applications would restart today. So things should sort of maybe be going back to normal. I was also told by some sources on background yesterday that it looks like things are heading in that direction. So at least one part of the student loan program should sort of kind of maybe be going back to normal soon.
All right. We will hang our hat on a sort of kind of maybe back to normal here for right now until we get more clear. Exactly. Jordan, thanks so much for breaking this down.
Yeah, thanks for having me.
Certainly. Job applications from federal workers are surging, especially from agencies facing scrutiny from DOGE. According to new data from Indeed, applications from workers at federal agencies under DOGE review surged by 50% in February. That's 75% higher than 2022 levels. Joining me now, we've got Allison Srivastava, who is the Indeed economist. Great to have you here with us. The data showing that the job search behavior of federal workers has roughly followed the trends of the broader labor market over the past few years. But this is a different situation. Can you walk us through it?
Right. So we really wanted to understand the impact of DOGE reviews on how workers with federal experience were approaching, job hunt. And we usually see a little bit of an uptick in applications for federal workers at the onset of a new administration, but nothing like this, 50% increase in a single month. And in particular, for those working with agencies under DOGE review is pretty substantial. It's definitely not something we'd seen before.
And so what are some of the biggest things that workers are looking for as they go through the search process?
This is a very particular subset of people. These are highly educated, they're more knowledge workers, and they're looking for jobs at a time when knowledge work is on the decline. The majority of these job seekers live outside the DC area. So, 80% live outside of DC. We like to think of federal workers as being really confined to that DC metro area, but it's definitely not the case. And the skills that these workers have are highly specialized. A lot of them are proficient in programming languages or policy analysts, very specific subset of workers with very specific high skills that are entering a public job market for the first time.
You mentioned job search activity for federal workers. It's happening across the country, not just the immediate area surrounding Washington, D.C. So what other areas are you seeing that are witnessing some of the most activity?
So we actually found the highest surge of applications in the southern region, and that's minus the DC metro area. So just the south minus DC metro area. Texas is a big employer of federal workers. So is California, Georgia. So it's really not just confined to that, DC metro area, even though the concentration might be higher.
So how many of these job seekers do you anticipate ending up in and transitioning over to the private sector?
Yeah, that's a great question. So, this is a good opportunity for state and local governments, and I'm sure many will seek employment there. But just given the sheer volume of federal workers applying on Indeed's site, I think a lot will end up in the private sector as well.
It's interesting. Are there any tips that you have for federal workers looking for jobs right now?
Definitely give yourself some grace. It's a lot to process, but as soon as you're able, really take time and assess your financial situation. So the average time it takes to find a new job is about 15 weeks, but it may be longer for federal workers because a lot of them are knowledge workers. And again, those are sectors that have just been in the decline for a while now. So I think prepare yourself for that. It's a great opportunity to do a career audit and really figure out what's important to you, where your priorities are. And I can never stress enough how powerful it is to leverage your network.
Allison.
Let others know that you're job searching, join professional groups, and really connect with people. I think that goes a long way.
Some really great advice, Allison. Thanks so much for taking the time here with us.
Thank you for having me.
Coming up, everyone, the number one thing a financial expert thinks you should be telling your kids about money. That's next on Wealth. U.S. consumer confidence fell in March, with Americans' short-term expectations for income, business, and the labor market falling to their lowest level in 12 years. Joining me now in studio with his advice is Rick Pitcairn, who is the Pitcairn Chief Global Strategist. Great to have you here with us. Rick, are you seeing the wealthy adjust their strategy for a market filled with uncertainty? You've got 10 million in AUM.
Yeah, they definitely have their radar up with this much uncertainty out there. one of the things that we try to counsel is, it really is the rare political phenomenon that impacts markets over the long term. We tend to get so emotionally invested in politics normally, and when they're like this, it's even like there's an exponent on that, right? That we're even really focused. But we try to help them to step back, make sure that they have a plan that's going to work over time, and let that plan work.
And so what is that plan looking like now? What's the shift been early this year as we are, about to close the books on the third quarter of 2025, or the first quarter
of 2025, which has been a weak one. And I think that, price always leads sentiment. So you see a lot of sentiment and a lot of fear as the price went down in those NASDAQ stocks. So we try to help them to step back and say, if you really take the politics and the emotion out of it, you had a Magnificent Seven that ran for an incredible period of time to incredible valuations. And if you look at it clinically, the pullback that we've witnessed so far is really quite logical.
Yeah. And so with that in mind, shifting gears here, a study from savings.com, it found that the share of parents financially supporting their children, it reached 50% this year. Rick, do you see this as a problem or just an outgrowth of challenging economic times that we've been navigating?
I think it is an outgrowth of the challenging economic times, and it sort of leads to a lot of what we do. Now, our families are at the top of the economic spectrum, very large, very complex families that we have the good fortune to serve. But everybody's interested in the care of the next generation, the education of the next generation, and how to set them up for success. So I think part of what you see in that data is that phenomena.
What are some of the issues that your clients are telling you about with making sure that they're not just having the wealth that they're able to maintain, but also kind of stewarding some of those good principles to the next generation as well?
That's a large part of our business. We do a lot on the investment side, but we do so much else to serve these complex families as they're trying to build 50 and 100-year plans. And I don't know any of them that aren't, we call it family engagement. We have a dedicated team, and all they work around is trying to get a look at that next gen, look at the family that's currently running the governance structure. Maybe they need some education and they need some skills that would help them more effectively run that structure, but certainly they want that next gen to be able to. So we have a ton of demand for different programs that help them understand not only the financial side of it, but the governance side of it, the trustee side of it. There's a lot of different elements that we help families with.
So interesting. What money lessons do you think all parents should pass down to their kids?
Well, the basic one I learned early, and it's hard to stick to, but if you spend less than you earn and save the rest, you're going to do okay, right? And your spending is the variable that's under your control, and that you should really pay attention to. And then secondarily, do it in the context of a plan. I see so many investors that, they have a good plan, and when emotion gets high like it is right now, they abandon. The plan is not until you feel uncomfortable. The plan is because you feel uncomfortable. That's when you stick to your plan.
The cost of living is so much different now for, Gen Z or even for the millennial generation versus baby boomers. And so where do you think that conversation and that acknowledgement is actually leading families to have a more holistic discussion around, hey, this is where you might still need support and we're willing to help, and then this is where I want to set you up to kind of release some of the reins and let you go into the future?
Well, that's absolutely the conversation, whether you're supporting them a little bit or a lot at a certain period of time. What you want to do is set them up so that they can fly on their own. And it's harder now. Definitely, there's different pressures. The country's changing, but I think my advice always is to stick to more of the basics. Don't get too caught up in the fad of the moment, and stick to basics like a long-term plan, like spending less than you earn and saving the rest. I continue to put things in the context of the things that have worked in the past, and they'll probably work in the future.
When you hear about the great wealth transfer, how are families thinking about this? And especially as we know it's going to benefit women to a greater extent with that money changing hands, we do know that it could even change the type of investment vehicles that some of the generational wealth gets put to work with as well. How are some of your clients preparing around that potential great wealth transfer?
Well, we're definitely seeing that. We just had an event week before last that was focused exclusively on women and women decision makers and families. That was very successful. And we just feel like that the investment world's changing. You see a lot of the young gen is very interested in private investments. We have a full bit of momentum behind the private investment world right now, so which is good. There's incredible opportunity there. You should do it in the context of a plan. Right. You should realize that there's high fees there, but the fact of the matter is that the families of the future are going to invest differently, and private and direct investments, more investments where these families have control over what it is that they're investing in. I think we'll see more of that in the future.
We're great to have you here in studio with us.
It's great to see you, Brad.
Likewise. Coming up, everyone, it's that time of the day. We're helping you spring clean your finances. We've gone over how to declutter your budget and fix up your debt strategies. But after the break, we're going to talk about organizing your investments. Stay tuned. Let's get a check of the markets here as we are a little over 2 hours into today's trading session. Take a look at the S&P 500 right now. We are down 0.5% year to date, still net lower by about 2.3% here. And ultimately, as we're taking a look at some of the pullback that's transpired over the month of March that we're trying to claw back here, we'll ultimately see exactly where the month closes out by the end of this week, early next week. And as we're taking a look at the S&P 500, we got to also take a look at the NASDAQ composite. Year to date, that's now lower by about 6.5%. That also factoring in today's declines of about 1.1%. The Dow Jones Industrial Average, you're seeing that higher today. That's up, bucking the trend. It's up by about 0.2% right now. Let's go a little further into some of the sector activity. Why don't we? Let's take a look at the 11 S&P 500 sectors pulled up here on the screen for you. Energy leading the pack, staples and financials also rounding out some of the advancers, the best of the advancers there. However, the worst of the decliners here, technology is down by about 1.3%. You're also seeing consumer discretionary and communication services. Those three have largely been in the red for much of the trading activity here on the day. Diving a little further into that technology trade, since that's bringing up the caboose, take a look at some of these declines. Yeah, NVIDIA also, I would surmise, or I would probably summon a guess, is probably the worst performer in the Dow, if it's the worst performer or one of the worst performers among the Mag 7 and in the NASDAQ 100. But we're taking a look at NVIDIA down 4.7% right now, and then additionally taking a look at Tesla. That is lower here during today's session by about 3.9%. So we'll keep close tabs, but all those Mag 7 names look to be in the red from what I can do a quick glance and see, and yep, it looks like that. All right, lastly here, a quick look at the Dow 30 components here. We're mixed, but looks like we're mostly in the green, being led by the golden arches, McDonald's. Well, as we wrap up the first quarter and head into spring, we're looking at some of the ways that you can spring clean your finances and set yourself up with a good financial habit and runway for the rest of the year. Today, we're focusing in on organizing your investments. And here with more, we've got Christine Benz, Director of Personal Finance and Retirement Planning at Morningstar. Christine, great to have you here with us. Let's start nice and easy with a lot of people's worker-sponsored retirement plans, AKA the 401k. So what can you be doing there to make sure you're set up for the year ahead?
Well, we're still early in the year, so it's a good opportunity to see how much you're saving. We have seen the contribution limits lift a little bit over the years with inflation. So if you're under age 50, you can get $23,500 in there. That's the max. If you are over 50, it's $31,000. And then there's this catch-up, this super catch-up contribution that's available for people who are getting quite close to retirement. So between 60 and 63, you can get almost $35,000 into a 401k. So see how you're doing in terms of those contributions, because it's just such a nice, low maintenance way to get money into your account on an ongoing basis.
So moving beyond your 401k, how can you clean up your broader portfolio and make sure the investments are working for you?
Well, a really good thing to look at today would be your portfolio's mix of stocks, bonds, and cash. Use a tool. We've got a good one on Morningstar.com, but there are lots of tools available where you can check up on how your portfolio is apportioned and then compare that to your target for your asset allocation. And at this point, a lot of people might say, I do not have a target, in which case you can either get some financial advice or you can use kind of a quick and dirty route, which would be to look at a target date fund that is geared towards someone at your anticipated retirement date, see how they are allocating their assets. Today, I think a lot of older adults, like people over 50, are pretty underweight relative to the reasonable targets for safer assets. It just has not been a great place to invest over the past several years to have investments in fixed income. But I think that safety is really important for people at that life stage to at least have something in safe assets. And then people who are younger, really check that non-U.S. relative to U.S. allocation. U.S. equities have been the path of least resistance over the past couple of years. So many investors are pretty underweight non-U.S. And of course, that's where the action has been so far this year.
And so the major key of this conversation also may come in two words, and that is risk check. How can people who are viewing make sure that they are performing a risk check to make sure that they're on track with their investments and balancing that risk reward?
Yeah, so checking up on that asset allocation is a key part of this. Also check your portfolio style and sector exposure. You were just talking about the tech names, Brad. Well, even though they have had bouts of underperformance so far this year, many investors are quite overweight in those U.S. large cap tech stocks. Maybe they will continue to perform well, but most investors are pretty heavily tilted there. So check up on your style and sector exposure and see if you can't tip more into some things that haven't performed as well that may do so in the future. Also check those company overweights. So many people receive incentives via employer stock. That's a really risky area to be in because so much of people's financial wherewithal is riding on their employment.
There's a couple weeks left until taxes are due, but how can you make sure that you're utilizing tax-efficient investment strategies for the year ahead?
So first, make sure that you are maxing out those tax-sheltered account types, whether company retirement plans, IRAs are a good contribution opportunity. If you didn't contribute to 2024, you can sneak in a contribution before that tax filing deadline. If you are someone who has the wherewithal to have investments outside of retirement accounts, you just want to make sure that those are positioned as tax efficiently as possible. So their broad market index funds make sense. Exchange traded funds that track the equity market are good options. For higher income people who need to have safer investments in those taxable accounts, you'd want to look at municipal bonds. So those would be some kind of best practices. And then in retirement, there's a lot you can do in terms of managing the tax burden of the money that you're pulling out of your retirement accounts.
Christine, thanks so much for taking the time with us.
Thank you so much, Brad.
Keeping with the spring cleaning your investments theme, there's a big mistake investors can make with their accounts, and it has nothing to do with what you're investing in, but rather who is entitled to the money. I'm talking, of course, about making sure your beneficiaries are up to date. And joining me now on set, we've got Bob Powell, host of Yahoo Finance, Decoding Retirement. Bob, great to see you. We got to know what, first and foremost, is a beneficiary? What defines a beneficiary, and why is making sure you have one or more so important?
Yeah, so a beneficiary is someone that you legally designate to receive your assets after you pass away, after you die. Pleasant subject.
But necessary.
But extremely necessary. So one of the things that these assets, some assets, not all, but your life insurance, your annuity, your IRA, your 401k, all get passed to a person you designate through a beneficiary designation.
Certainly. And so spring seems like a good time to check in on your beneficiaries, but when else do you need to consider making changes?
Well, I think anytime there's a significant life event, the birth of a child, a divorce, the death of a spouse, et cetera, it's always a good time to check in on your beneficiary designations. The last thing that you want to have happen, Brad, and it often does, is someone might get divorced. Mm-hmm. And then the next thing you know, that person dies, but they never change the beneficiary designation, so their ex-spouse gets $1 million in life insurance proceeds because someone forgot to change their beneficiary designation. So two things, why is it so important? Mm-hmm. The beneficiary designation allows you to direct who will get the assets after you die. Mm-hmm. So there's the primary beneficiary that you need to name, and also a contingent beneficiary. So maybe you might name your spouse as your primary, and then your children as your contingent beneficiaries. And those are really important. Now, the other thing about this is beneficiary designations. Let's say you don't have a beneficiary on your IRA or your life insurance policy.
Sure.
Then those assets get distributed according to state laws. And it may end up that these assets go to someone that you didn't want to have So it's really important to check these things. And tax season is a good time to do that because oftentimes you're asked on your tax form to look at your IRA assets,
Right.
Form 5498, I think it's called. And that's a good time to say, okay, well, I'm looking at my traditional IRA, I should also look at my beneficiary designations. The other thing that I should note too, Brad, we talked about contingent beneficiaries. You can name multiple beneficiaries and have the assets split up on a percentage basis or on an equal basis, et cetera. So don't think that it's just one person. It could be multiple people that are receiving your IRA, life insurance proceeds, et cetera.
Walk me through some of the documents that are critical to make sure you're up to date with your estate planning, and what are some examples?
All right, so the most common example is a will that designates who gets your assets after you pass away. But there are several others that are really important. The durable power for financial matters designates someone to handle your financial accounts if you become incapacitated. Then there's something called the durable powers for healthcare matters, or sometimes a healthcare proxy, and that designates who will make healthcare decisions for you if you become incapacitated. And then the last thing would be the advance directive, which sort of outlines what are your wishes for end-of-life care. Sometimes a living will is part of that document because that says what kind of drastic measures should be used or not used to keep you alive. And then there are two others. Sometimes estate planning attorneys will include them. One is something called the DNR, the do not resuscitate, and the other is something called the medical or physician orders for life-sustaining treatment. Again, it outlines how far you want a doctor to go in order to keep you alive or not.
How young should you be when you're creating these documents?
I think the moment you reach the age of majority, you should have all these documents in place. So once you're 18, you need all these documents in place, including, we didn't mention, but a HIPAA release, which allows someone, a doctor, to talk to your loved ones that you've designated to hear medical information about you. And so the moment you turn 19, your parents aren't legally allowed to talk to the physician unless there's a HIPAA release in place.
Really?
Yeah.
Wow. Okay. All right. I got some work to do this weekend. Bob, thanks so much.
Thank you, Brad.
Appreciate it. Coming up, Apple sharing the first details about its upcoming developers conference that is next on Wealth. A programming note. On today's episode of Trader Talk, Kenny Polcari sits down with the former CEO of Drive Wealth to explore how embedded finance, fractional trading, and digital innovation are transforming the brokerage landscape.
Define it for the audience. Define what embedded finance means.
So the traditional retail customer comes via a Schwab account or an online brokerage account.
Right.
Embedded finance now is built digitally, natively, and digitally into embedded wallets, into e-commerce players, all different services that you see these days with roundups, rewards, all different programs.
Okay.
Notional-based investing, fractionalization, trades all the way down to $1. So embedded finance has proliferated now across the globe. There's more digital wallets than there are brokerage accounts in the United States and collectively across the international
Which
region.
I find amazing.
You can watch Trader Talk with Kenny Polcari every Wednesday at 12 p.m. on Yahoo Finance or wherever you get your podcasts. It's time for Tech Support, our weekly segment about all things tech. Apple's annual Worldwide Developers Conference is just over 2 months away, and the world's largest company releasing the very first details about the 2025 event. Here to break it down, we've got Yahoo Finance tech editor Dan Halley. So Dan, when will it all go down?
June 9th. I will be flying out June 8th.
Hey.
I'd like to get there a day early, get a little bit of, tacos and some Thai food out there. This is really the kind of big software event for Apple, right? Like, this is where Apple lays out what the software ecosystem is going to look like for the next year. Now, last year, what we got was the new Apple Intelligence. That hasn't really gone over very well. The updates to iOS, Mac OS, iPad OS, Watch OS have been good except for Apple Intelligence. It's kind of fallen flat. We've seen some of the features come out, but that new and improved series still isn't here yet. We were expecting it sometime before WWDC 2025. They had said last year that it would come out within the year, and that time is quickly approaching, and Apple had said, look, it's going to be ready some point later this year. So what we're expecting now will be the latest updates to iOS. It would be iOS 19, iPad OS 19, new version of Mac OS, new versions of Watch OS, as well as the Vision OS ecosystem. We should get more Apple Intelligence updates, Hopefully we hear more about what's going on with Siri. This was supposed to be a big moment for Siri, a reinvention of it. Apple ended up adding ChatGPT integration. They have what's called visual intelligence, which is really helpful in certain situations to the iPhone 16 line, where you can kind of take a picture of something and then ask a question about it. I've used it before. It's been great. But we want to see more from Apple on that. And there's also the potential for hardware announcements. It's not normal for them to do that, but every once in a while they'll throw in a piece of hardware that's interesting. So it's a lot that's going to go on. I do think that Apple is kind of under the gun here when it comes to Apple Intelligence, and proving that this product that was supposed to really goose iPhone 16 sales is still worthwhile. It'll just take a little bit longer than they originally thought.
Relative to past updates, how important is this one? We only got 10 seconds.
I think this might be one of the most important updates in some time, specifically because of Apple Intelligence and what that kind of means for Apple going forward.
Dan, appreciate the time. Thanks so much. Can't wait to see you on the way out there, and you got to report back on all the eats that are taking place too.
Yes.
That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination coming up 3 p.m. Eastern Time. They'll count you down to and through the market close.